So we think about this as a value-focused investment grade mandate, and value because we're trying to achieve a maximum yield for default probability that we're taking on. There's three key characteristics of the fund. So one, we adjust credit exposure opportunistically. So based on the market backdrop, if we might not have a full allocation to credit depending on the potential for macroeconomic weakness, for instance. We take a countercyclical approach to duration and credit exposure, so more of each when we're getting adequately compensated for those things and less when we're not, based on the level of the term premium and what credit spreads are doing. And then thirdly, we're able to invest up to 25% in non-investment grade securities, and we do that either by holding Pender Corporate Bond Fund units or by investing in individual high conviction line items that we think have the potential to outperform the corporate bond fund as a whole. I think that we think about ourselves as business analysts first, so we do a lot of fundamental credit work, and we're really trying to determine the value of a business, and therefore if that value covers the debt outstanding or to the level of the capital structure that we're invested in. So we actively manage credit and duration exposure. So for instance, if you look back to August of 2020, the term premium was the most negative through that period, and we were positioned with relatively shorter duration in the funds. It was probably the worst time in history, going back to the 60s, that we've seen to own longer dated bonds. So, and what we saw from that point forward was the yield on the 10-year went up over 3.5% from that point forward. So actively managing duration exposure is one thing. In terms of credit exposure, for instance, going into COVID, the fund was positioned with relatively less credit exposure. And through that period, through COVID, we saw BBB spreads blow out to about 5%. So at that point, we were able to reduce our weighted government bonds that had been bid up to quite low yields and pivot into a little bit of a heavier weight in the BBB line of credits, and that helped performance coming out of that period. In addition to that, the individual non-investment grade lines that we hold in the portfolio where we have high conviction, those have been a key driver of returns in the fund since inception. So the majority of the fund is in liquid, high-grade credit. And so that provides ballast and also liquidity to the fund. We don't reach for yield in terms of extending duration, so that moderates volatility to some degree. And we're looking for areas of the market that are relatively undervalued and that would benefit from a rotation out of the more expensive areas of the market and into these areas. And that's produced returns over the longer term.